How does owning a crypto exchange actually make money? And what can cause the business to collapse? On July 16, 2026, Citadel Securities invested $400 million in Crypto.com, valuing the company at $20 billion. Yet only 2 months earlier, Coinbase announced 700 job cuts, despite generating more than $1.4 billion in its latest reported quarter. That seems like a contradiction. How can an exchange generate billions in revenue and still be forced to cut costs? Today, we'll open the books on the revenue, operating costs, liquidity, regulation, security risks, break-even pressure, and whether owning a crypto exchange is truly worth it. The simplest revenue stream is the trading fee. Every time a customer buys or sells, a centralized exchange can collect a fraction of the transaction. The percentage may look tiny, but exchange economics are built on repetition. A small fee applied to billions of dollars of daily volume can become an enormous revenue stream. Exchanges can also earn through spreads, staking commissions, institutional custody, margin and lending products, subscriptions, derivatives, payments, and income connected to stablecoin balances. The latest official Coinbase results show how broad the model has become. In the first quarter of 2026, Coinbase reported total revenue of roughly $1.41 billion. Transaction revenue was about $756 million, while subscription and services revenue was about $584 million. Stablecoin revenue alone contributed approximately $305 million. Coinbase also said its retail derivatives business had exceeded a $200 million annualized revenue rate, while prediction markets reached a $100 million annualized rate within their first 2 full months. This diversification matters because trading revenue can collapse when the market becomes quiet. Stablecoin income, custody, subscriptions, and institutional services can continue earning even when fewer retail customers are pressing the buy button. The modern crypto exchange is therefore not just a marketplace. It is trying to become a brokerage, custodian, payments company, derivatives venue, and financial infrastructure provider at the same time. This business can be extremely profitable, but it is also brutally cyclical. During the 2021 crypto boom, Coinbase generated about $7.4 billion in net revenue. In 2022, after prices and trading activity collapsed, net revenue fell to roughly $3.1 billion. The same pattern returned in early 2026. CoinGecko estimated that the total crypto market lost about 20.4% of its value during the first quarter, ending March near $2.4 trillion. Spot trading volume across centralized exchanges fell about 39% to $2.7 trillion. Coinbase still produced positive adjusted EBITDA of approximately $303 million in that quarter, but it also reported a net loss of about $394 million. Then, in May, it announced the 14% workforce reduction and estimated $50 to $60 million of restructuring costs. For an owner, the lesson is simple. Market volume is not dependable income. A responsible exchange cannot build its permanent cost base around the best months of a bull market. It needs enough cash to survive weak markets, regulatory delays, security incidents, and sudden withdrawals. Scale helps. CoinGecko estimated that the 10 largest centralized exchanges processed about $18.7 trillion of spot volume during 2025, with Binance accounting for roughly 39%. But Binance is private and does not publish the same audited quarterly financial detail as Coinbase, so outside revenue or profit estimates should never be treated as confirmed figures. A first-time founder may imagine that building an exchange means paying developers to create an app and an order book. In reality, the matching engine may be the easiest part. The first major cost is regulation. In the United States, a crypto exchanger can be treated as a money transmitter under federal FinCEN rules. They also need state licenses, surety bonds, compliance systems, examinations, and specialized legal advice. Serving New York customers can add the separate BIT license or another approved New York regulatory structure. Europe has become even more immediate. The maximum MiCA transitional period ended on July 1st, 2026. A company providing covered crypto asset services to EU clients now generally needs MiCA authorization or must stop providing those services where it is not authorized. The United Kingdom is moving toward another regime. Firms providing covered crypto services currently need registration under the money laundering rules. Applications for the new authorization regime are scheduled to open on September 30th, 2026, with the new framework expected to begin on October 25th, 2027. The United States also enacted the Genius Act in July 2025, creating a federal regulatory framework for payment stablecoins. For an exchange owner, stablecoins may become a larger and more trusted revenue engine, but only alongside stricter reserve, disclosure, and compliance requirements for the issuers and partners involved. The second major cost is security. In February 2025, attackers stole approximately $1.5 billion in virtual assets from Bybit. The FBI attributed the attack to North Korea. Coinbase faced a different kind of attack in 2025. Criminals bribed overseas support personnel to obtain customer information for social engineering scams. Coinbase initially estimated remediation and reimbursement expenses of approximately $180 to $400 million. In its second quarter 2025 results, it recorded roughly $308 million in other operating expenses, substantially all connected to that incident. An owner therefore needs cold storage, access controls, fraud detection, cybersecurity specialists, insurance where available, external audits, internal monitoring, and an incident response plan. Security is not a one-time technology purchase. It is a permanent operating expense. The third cost is continuous operation. Engineers, customer support, sanctions screening, tax reporting, cloud infrastructure, wallet maintenance, banking relationships, accounting, legal review, and monitoring every hour of every day. Then comes liquidity, the cost many new owners underestimate. Customers stay only when they can trade quickly at competitive prices. An empty order book creates wide spreads and poor execution. A new exchange may need market maker agreements, trading incentives, connections to outside liquidity, or its own capital committed to keeping markets functional. Finally, the owner must acquire trust. That means spending on customer acquisition, brand credibility, transparent custody practices, proof of reserves reporting, banking access, and customer protection. Software may launch the platform. Capital, liquidity, compliance, and trust keep it alive. Consider a simplified example. Suppose a smaller exchange reaches $100 million in monthly trading volume and captures an average effective rate of 0.2%. That would produce about $200,000 in gross monthly trading revenue. But gross revenue is not owner profit. From that amount, the exchange may need to pay transaction processing costs, banking fees, liquidity incentives, cybersecurity, engineers, compliance staff, customer support, legal advisors, insurance, cloud infrastructure, and marketing. And if monthly volume falls by half, most fixed costs remain. This is why an exchange can process more than $1 billion of customer trades and still fail to generate meaningful cash for its founder. The owner has three possible levers: attract more volume, capture more revenue from each customer, or reduce the fixed cost of the operating model. But each lever has limits. Higher fees can drive customers away. Lower security and compliance spending can destroy the business. And attracting serious volume usually requires expensive liquidity and marketing. The economics become powerful after scale is achieved. Reaching that scale is the dangerous part. FTX remains the clearest warning about what an exchange owner must never do. The company grew rapidly and presented itself as a safe place to hold and trade crypto. But customer money was transferred to Alameda Research, a trading firm controlled by the same founder, and was used for investments, political contributions, real estate, and to cover losses. When customers rushed to withdraw in November 2022, the funds were not available. The exchange collapsed within days. Sam Bankman-Fried was convicted on 7 fraud and conspiracy counts, sentenced to 25 years in prison, and ordered to forfeit more than $11 billion. On June 12, 2026, a federal appeals court rejected his attempt to overturn the conviction and sentence. Binance demonstrates a different ownership failure, pursuing scale without adequate compliance. In 2023, Binance pleaded guilty to anti-money laundering, unlicensed money transmission, and sanctions violations, agreeing to pay about $4.3 billion. Its founder also pleaded guilty and resigned as chief executive. These cases are different, but the economic lesson is the same. An exchange owner controls a company that holds customer assets and moves money across borders. Weak governance does not merely reduce profit, it can create criminal liability, regulatory exclusion, and a run that destroys the company in hours. On an exchange, trust is not an extra feature. Trust is the product. A funded and compliant exchange faces pressure from both traditional finance and decentralized platforms. From above comes Wall Street. The latest Crypto.com deal is a clear example. Citadel Securities did not invest $400 million merely to own another retail trading app. The stated goal was to expand into tokenized securities, derivatives, and a wider 24-hour financial ecosystem. Coinbase is following the same direction. It now describes itself as an everything exchange and earns across custody, stablecoins, derivatives, prediction markets, institutional services, and trading infrastructure. Traditional finance is no longer simply competing with crypto exchanges. It is investing in them, partnering with them, and using their infrastructure. From below comes decentralized trading. CoinGecko estimated that perpetual decentralized exchanges expanded from about 2% of perpetual trading volume to roughly 10.2%, while volume grew around eightfold over the measured period. Hyperliquid and similar platforms allow users to trade directly from wallets without depositing assets into a conventional centralized exchange account. These platforms can reduce some custody and corporate overhead, but they create different risks: smart contract failures, oracle problems, governance concentration, limited consumer protection, and unresolved regulatory questions. A centralized exchange is therefore squeezed between institutions with stronger regulatory relationships and decentralized venues with leaner structures. The strongest defense is to become infrastructure rather than remain a single-purpose app. Economically, a crypto exchange is at least 3 businesses combined. It is a trading venue with highly cyclical fee revenue. It is a custodian and financial services platform that can earn steadier revenue from assets, subscriptions, stablecoins, and institutions. And it is a trust broker whose value can disappear when customers doubt that their assets are safe. For an owner with substantial capital, experienced compliance leadership, institutional-grade security, banking relationships, and a realistic method for attracting liquidity, the upside can be enormous. The $20 billion Crypto.com valuation in July 2026 shows that investors still believe the infrastructure can become extremely valuable. But for an undercapitalized founder, this may be one of the worst financial businesses to enter. The code can be purchased or copied. The difficult assets cannot. Licenses, market liquidity, banking access, security culture, reputation, and customer trust. So would I own a crypto exchange? Only if I had enough capital to survive several weak years, enough regulatory expertise to enter each market legally, and enough credibility to convince customers that their money would remain available during the next crisis. Otherwise, owning the exchange is not owning a money printing machine. It is owning the risk behind every transaction. If this kind of breakdown is your thing, that is exactly what this channel is built around. How money actually works, from billion-dollar businesses down to your own wallet. Subscribe for the next business breakdown, and tell me in the comments which company or industry you want us to open up next.